Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest is Scott Hazlett, and Scott is a California attorney and CPA who practices in the areas of taxation, real estate planning, financial problem resolutions, and 1031 exchanges. He is a certified specialist in taxation law, California State Bar Board of Legal Specialization. He is also a qualified intermediary for tax-deferred exchanges. Scott previously worked with Price Waterhouse and has been a CPA for, over 30 years, I guess, and
Yes.
attorney for over 20 years. Scott graduated from the University of Michigan with a degree from its business school and from Taft University School of Law in 1996, and then formed his own law firm. In a past life, Scott was a sports writer covering Major League Baseball, National Football League, and other sports. Scott, thanks for joining me today.
Thanks for having me. Appreciate it.
Okay. Today, Scott and I are going to be talking about a sale of a principal residence. Believe it or not, we're not going to be able to cover everything about it, and we want you to get professional advice. Also, the rules are a little up in the air because of possible tax reform. Today is May 23rd, 2017. I have a book that I've written that will probably soon be out of date. It's the Real Estate Tax Handbook. This is available on Amazon and at realestateinvestingtax.com is our website related to that. All right, Scott, let's get into this thing. Here's a question that I know that you get, like me, all the time. If I sell my residence and replace it with another one, does that defer the gain?
Yeah, so we were just mentioning before we went on, it was 20 years ago, amazing piece of legislation came down, which is this expanded Code Section 121 that provides for a permanent exclusion of gain, which was highly different than the old scheme that you're mentioning. So people are still thinking about what it used to be like before 20 years ago, which is, if I sell my house, how much of a house do I have to buy as a rollover concept, much like what we have as a 1031 exchange. So the answer is that I don't care how much you spend for the new house or when you buy it, it doesn't make one bit of difference.
They told me at my bridge club that...
Yes, exactly. I read on the internet, or my bridge club, or my best friend, or my hairdresser, and so forth and so on. Whenever I hear that, I say, I promise never to join your bridge club or do hair. I leave that for experts.
Okay. So what are the basic guidelines for the sale of a residence?
So today, under today's environment, if you sell a property that is your principal home, if you've owned the property for 2 out of 5 years ending on date of sale, and you've occupied it as your principal home for 2 out of 5 years ending on date of sale, when you sell it, there's going to be a gain. And for a single individual, $250,000 of the gain is completely excluded from tax. If you are married filing jointly, $500,000 of the gain is excluded. If you are two single people who co-own a property, say 50-50 to keep it simple, then each of those persons is entitled to their own 250,000. So it can equate to the $500,000 that a married couple would enjoy. Now, owned and occupied. Well, owned is pretty easy if you own the property. Occupied, is it your principal residence? So there's these guidelines that are issued in the regulations. What is your principal home? Where do you vote? Where do you go to church? Where's the proximity to work? Address on your federal and state income tax returns, page 1 of Form 1040. Where do you socialize, and so forth and so on. Typically, this is proven by things like credit card receipts and just your general conduct. So if you say, look, I'm living in Tahoe as my principal home, and they pull out your Visa statement, and you're buying your Safeway and your Chevron in Sunnyvale, guess what? You're not living in Tahoe, you're living in Sunnyvale or that area, for example. So that's what a principal home is. Now, interestingly, the property does not have to be your principal home at the date of sale.
Mhm.
Okay, so it's 2 out of 5 years. So what that really means is a one way to look at it. If I've owned and occupied a property for 2 years, and then I leave and I occupy some other property, or I rent a property, or I go away, I've got up to 3 years to sell it and still invoke that rule, because it's a 5 years from date of closing looking back. So it's a very interesting rule.
Okay. What happens if you acquire the residence in a tax-deferred exchange?
So the rules changed slightly. There was a thought here after this, between the years 1997 and 2004, there was a strategy of, I'll sell my commercial building, I'll buy a house, I'll rent the house out for some length of time, which is still of great controversy. And after that some length of time, say a year or two, I'll move into the house for 2 years, and then I'll sell it, and then I can get a gain exclusion, and I can avoid, the 1031 simply is a deferral. It's
right.
You're just delaying the pain, whereas this is a permanent exclusion. So you convert that gain into a permanently excluded gain on sale. So Congress viewed that as a loophole in the rules, and so it instituted a rule that requires a 5-year ownership period. So if you buy a replacement property in a 1031 exchange, which is a residence, a single-family dwelling, or a condo, that type of thing, the advantage of this 121 rule, the home sale exclusion rule, does not trigger until after 5 years of ownership, even though you may have lived in it only 2 years of the 5. So that's an additional requirement.
Yeah. So one thing I want to sort of point out is these thresholds, these exclusion amounts, haven't changed for 20 years.
Correct.
So if we look at what's happened with inflation and so forth, and especially with property values, when we talk about areas like Silicon Valley,
Yes.
it ain't such a break anymore.
No, it's not such a good deal. So interestingly though, if you we're in our little high-end bubble
Yeah.
here, and that's just reality. I live in the East Bay, and
Yeah.
we have a nice neighborhood, and it's really expensive to live there. I mean, let's face it, the tech companies have done well, and everybody's doing well, and they're bidding up these properties. And so when you sell a property and you say, wow, I've got a $2 million gain and I get half million, what do I do with that other million? So let me digress into a case study here. So let's say somebody lives in Saratoga, and they bought their property a long time ago, and when they go to their accountant, they say, look, we're going to sell, it's time to downsize, we're moving away, we're going to Palm Springs, we're going to San Diego, we're out of here. Property's worth $3 million, and we bought it a long time ago, so we paid $500, and we haven't really done any improvements to it. So
how about we paid $50?
Yeah, right, correct. Correct. So let's just assume you've got a gain of, for sake of discussion, of $2 million.
Mm-hmm.
Okay, if you sell today, you get $500,000, you're married filing jointly, or maybe $250,000, let's call it $500,000. So you still have a taxable gain, long-term capital gain on your tax return, and of course California taxes that as ordinary income. And so you pay roughly 22 to 33%, depending on a lot of things, on this gain. Now, there's an interesting rule that says that you can use this exclusion rule in conjunction with an investment property 1031 exchange. So it works something like this. So if you sell today and you trigger that gain, you're going to pay a lot of taxes. There's no way around it. That's just an absolute. If you move away from the property and you convert it into an investment property by renting it to third parties on a business-like manner, now you've changed the character of the property to investment property. But remember I said a minute ago, if you sell within 3 years of departure, you can still capture the $500,000. So this works in a way best of both worlds. You capture the $500,000 exclusion, and so let's say that $3 million property, here's how the math works. You sort of shave the first $500,000 off, and now you got a $2.5 million sale. If you go buy some investment property elsewhere, a Walgreens building, or maybe an apartment building, or maybe even another house, you can defer the rest of that gain into that next property, and you pay no taxes on the sale. So it's a little bit of a hassle and so forth, but it's possible for you to implement that. That might help somebody out there.
Yeah. Another alternative is to wrap in an installment sale.
Correct.
So then, basically instead of taking everything up front, you carry the paper, the
Yes.
mortgage related to the property, and as it's paid down, you pay the gain.
You
And-
spread it out,
and-
but
yeah.
you won't avoid it.
You won't avoid it. But again, if you're like some seniors and you don't have a whole lot of income, at least right now, so if you're not over the 15% tax bracket, capital gains are tax free.
Correct.
So it depends on your circumstances. I've had an awful lot of people that I try to talk about some of these strategies, and they just said, I'm just going to take the money and forget it.
I
So
I hear you. Well, and also in that strategy, there's a lot beyond your control. I mean, you don't know when you're going to get paid off and so forth, and you can't prevent that. So, and the other problem is you don't, when there's an installment sale, even if you die, you don't get a step up in basis. Your children inherit your problem. So that's really the issue.
right.
So.
What if the house is used for a non-residential purpose or for rental? How does that affect this whole thing?
So the two most common things along those lines, if I follow where you're going, is office and residence, and also the ever popular roommate situation.
Well, I'm
So-
also thinking of just the thing, what if you had a property that you were using as a rental and then you moved into it?
Oh, I see. Okay.
So now,
Okay. So different rule. So then we'll come back to that if we have time. So it used to be that the tax advisor would get a call from the taxpayer, and the taxpayer would say, well, I'm selling my house. And the tax advisor would say, have you lived there 2 years out of the last 5? Yes. Have you owned it for at least 2 years? Yes. Okay, fine. You can sell it. No problem, no problem. You can't do that anymore. It's not that simple anymore. The right question is now you have to go back and study the history of the property. Tell me about when did you buy it and what has been the history. Oh, you've lived there, you bought it on 1104 and you've lived there as your principal home. Okay, then you're fine, you're safe. Okay, oh, you lived there and then you moved to Australia for 2 years and you rented it out and then you moved back and then you did this, that, and the other thing. You have to go into a whole new analysis about use. There's this concept called the non-qualified use, and there's a statute put in for those people that are interested, 121B5, B is in Baker 5. And that rule says that even though you might meet these general requirements, you won't necessarily have all of the gain excluded. Some of the gain may be ineligible due to this other use. And the other use isn't necessarily a rental property. It could be a vacation home was a personal use. This is what I call the Florida-New York problem. So the rule emanated from people that were living in Manhattan, and then they'd have a vacation home or a winter home in Miami, let's say. And so they would call up their tax advisor and they'd say, hey, we're not traveling to Miami as much, we're going to sell the property. And the tax advisor would say, well, you've got a big gain, but if you move there and you stay there long enough and so forth and so on, then you'll meet this 2 out of 5 year rule that you can sell that and get a pretty big tax break or perhaps no taxes at all. So Congress viewed that as a loophole for the rich, as they so often do, and they said, wait a minute.
Congress needed some more money.
They needed some more money, exactly. How are we going to pay for this? So they created this scheme where if you have these so-called periods of non-qualifying, in other words, it's not your principal home, then those periods lead into a fraction and a really complicated formula in the tax code that basically makes ineligible a portion of the gain for this special rule. And if you do the math, some people win, some people it's pretty bad, and some people it doesn't really affect them. It just depends on the numbers.
Yeah. Now, if you're just away like for a vacation, the regular vacation thing,
Yeah,
2 or 3
big
weeks,
deal.
no problem. That's
No
still
big deal, right?
personal use.
And then there's all kinds of rules about you're a senior, you go to a senior home and you get credit for that and so forth. Those are all written in the statute. So,
Yeah.
but the takeaway on any of that is, if you have any doubt, call your tax advisor. Call your tax advisor.
Or call a tax advisor, because there's a lot of people that do their own taxes, right?
Right.
This is not the TurboTax
No.
sort of scenario.
No, in fact, I just saw the court case. The tax court denied
Right.
abatement of the penalties for the TurboTax, blaming TurboTax for doing his taxes
Yeah,
wrong.
it was
so.
TurboTax's fault.
Yeah.
Okay. What about accumulated depreciation? How's that handled when you sell a principal residence?
So if notwithstanding the fact that we get past this non-qualified stuff that we just talked about, there's a rule. Well, first off, let's take a step back. When you sell real estate, there's two types of gain associated with that for federal rules. One is sort of the economic gain. You buy it for 100, you sell it for 150, you have this gain of 50. That's what we commonly call the capital gain. And then when you have the property and you're renting it out, you started at 100, it decreases, the basis decreases for the depreciation. So you depreciate it, it's $4,000 a year, it goes down a little bit, and you might have over a 5-year time frame, you might have 20 or 25,000 of depreciation that you've taken as an expense on your tax return, but it's sort of lurking out there. So now when you sell the property, that's considered to be recaptured income. It was deducted earlier and then it's recaptured later. It's kind of a good scheme. You get an early deduction and you get a gain later. For when you move into the property and you create this principal home characterization and you go for the gain exclusion, the rules specifically deny the benefit of this for the depreciation. So my example, let's say I got $25,000 of depreciation and I sell the property. Well, I might get the 50 tax-free because that's the economic gain, but the other 25, that depreciation, that's going to be definitely captured into taxable income. This rule will not help you for that.
Right, and it's also taxed at a higher tax rate.
That's
right?
correct.
It's not eligible for the long-term capital gains rate.
Correct.
So it's like a 25%
And
tax rate.
always remember Jerry Brown is lurking. Jerry Brown is there, and people say, I get this all the time. Well, capital gains rate's 15%, right? I say, well, you're not. That's just Donald.
Yeah,
You
in
know,
California,
in California, we always worry about Jerry up to 13.3%. So
yeah, it can be.
And
Yeah,
I'm on record. I'm going to blame Jerry even after he's out of office. I'm still going to blame him.
Well, it's not just Jerry. I mean, the voters had something to do with this too.
I hear you.
Well, anyway, so another thing I wanted to mention, though, for folks, that we speak accounting language and tax language. So basis is like the cost that you use to determine gain and loss.
Correct.
And you subtract from the cost the depreciation as you're going. That's what we call the accumulated depreciation. All right. Well, what if you have to sell the home because something happened? Oh my gosh, my wife had twins after we moved in. Or
right. So there was this 2-year rule is an absolute rule, except not always, which is so true in the tax code. So when the law got implemented, Congress understood that sometimes we live in houses and life happens. And so we might get a job offer in a different city for a transfer. We might get sick and have to move to the desert or the mountains for our health, or what the statute calls other unforeseen circumstances detailed in the regulations, which, by the way, that last little bit, detailed in the regulations, that's very important, because you can't just make up your own unforeseen circumstances. They have to be well defined. So the rule is that you get a partial benefit of the, say, 250 or 500 for the amount of time that you've owned and occupied the property. So let's say you buy a property today, May 23rd, 2017, and you pay 100, and you live there for a year, and at the end of the year, your employer says, we're transferring you to Los Angeles because you got a promotion and all this kind of stuff, and so you're in San Jose and you go to Los Angeles. So that's a job change, and so it's logical that you would leave. And you don't really have enough money to have 2 houses, so you have to sell the house in San Jose. So you sell the house in San Jose, you bought it for 100 shekels, now you sell it for 125 shekels. And so there's a gain. Well, you can take a portion of the exclusion, which would cover it in that example. So if you have 250 available to you ordinarily, and you have 1 year out of 2, then you get half of it. You get 125. So at least you get some exclusion.
Right. Okay. What if you bought this residence before August 6th, 1997? Any anything to think about there?
Oh yeah, oh yeah. So this gets back to the. I hate to admit how old I am. Since I was here when the rule changed, as you were, of course, in the practice.
Uh-huh.
So when people came to somebody like you or me to sell their house before that August 5th date in '97, they would ask the question, I'm selling my house, what do I have to do? And it was what's called the residence rollover rule. And you could go back 2 years or go forward 2 years. And the so-called basis, the base on which you're measuring your gain, was not just the price that you paid for a house that you bought, but it might relate to a prior house. So it's possible. So consider this scenario. So, Hal and Wanda get married in 1960, and they buy their first house in San Jose for like $10, and then their family grows a little bit, so they sell that house in 1964, and they buy another house in Sunnyvale, and there's a gain from the first house, but they don't pay any taxes because all of the gain is sort of plowed into the next house, and so forth and so on. And then the Sunnyvale, and then he moves to Los Angeles for a job change in 1975, and then a variety of things. So then they were sitting in a house in, let's say, Gilroy in the year 2000, and they sell, and they're saying, wow, they've got this new rule where we can get 500,000 exclusion, and we don't have to worry about it, and so forth and so on. Well, the question is, how do you compute the gain? And the gain is based on going all the way back to San Jose in 1961, because all those bases are adjusted because you basically pay the piper. Mm-hmm. And so there's a lot of inquiry. Basically, it's factual inquiry. You got to keep all your paperwork, got to keep all your escrow statements. That's what scanners are for now. It's okay to scan everything. Don't throw it away. Scan it first, at least. But there is an issue with that still.
Right. And sometimes it's hard to put those things together.
Mm-hmm. Sometimes we look at old property deeds, and they've got transfer tax stamps, and you do a calculation and say, well, that was so much tax, and then we know what the rate of the tax was, so that we can sort of deduce the price, what they paid for the property, those types of things. So
yeah. Okay. When he says the tax, he's not talking about income taxes. He's talking about transfer taxes. Okay.
Right.
So we figure what the amount of transfer tax. What value that relates to. Yeah, fun. Okay. Well, you and I aren't seeing this very much anymore, but there's still a few out there, short sales. So what if somebody had a short sale? Can this help in that sort of scenario?
Yeah, so the best way to describe the short sale is first explain what it is and then give you an example. A short sale is a sale of the property, or sometimes it's a foreclosure, but let's call it a sale of the property, where the sales price is insufficient to pay off the loan. So let's say you had a loan of $300 against a property, and you sold the property net of any commissions and selling costs, and you got $200,000. So the lender's saying, hey, you owe me $100,000, and mm-hmm. you're saying, hey, I don't have it. Mm-hmm. And so the lender says, in order to make the thing go through, they waive $100,000 from their loan balance, and they collect the $200,000, and then the rest of it's forgiven. Okay, so that's sort of the basic fact pattern. Now, in that scenario, this forgiveness amount, which is $100,000, the forgiveness amount is considered ordinary income. Okay. The 121 rule that we've been talking about is a gain exclusion on capital gains, not on ordinary income. So generally speaking, this $100,000 is a ordinary taxable income. And there's a whole bunch of other exclusions related to that, but this rule will not help you resolve that. Now let's say, for example, that you sold this property for the $200,000, and let's say your original purchase price was $50,000, and you're married, filing jointly. You have a gain of $200 minus the $50 that you paid. So that's a gain that will be eligible for the exclusion. So you won't pay tax on that, but you're possibly going to pay tax on this other $100, which is the difference between the loan amount and what they actually received.
Right. But what if it was a non-recourse loan?
Okay, well that's a little different. So in the tax rules, in the capital gain tax rules under 1001, there's a rule that says if your property, if the short sale occurs with respect to a non-recourse loan, then in this example, let's use the 300 again. If that's a non-recourse loan, then the 300 is considered sales proceeds. So if you paid 50 for it, it's like you received 300,000, and the difference, of course, is 250. In that case, you'll get full benefit of the exclusion rule for the gain.
Right.
Okay.
Okay. We're really just about out of time, so maybe I'll throw it to you again and see if maybe you have some final words of wisdom related to sale of residence.
Well, I mean, there's no substitute for calling a professional advisor. Just to say we're doing something, because you just don't know about all the side effects. I mean, there was a recent broadcast on property tax considerations and so forth. So there's a lot of different things, and sometimes it's good. We do a lot of exchanges, of course, and we always talk about, well, why are you doing the exchange? Well, to save taxes. Well, that's really a dumb reason. You should be doing a transfer because of non-tax reasons. I mean, but where are you headed? Why are you doing this? What's going on there? But as far as doing the planning, I think if you're just talking about this statute, somebody calls up and says, "Hey, we're selling our house," I'm immediately going into question mode. Okay, when did you buy it? What did you pay? Were there improvements? What's the loan balance? I want to get kind of a flavor for this. Did you always live there? That I didn't. So I want to get a flavor for that. I don't really know that there's a website where you can just go click on a website and it would have all these questions that are detailed to your specific circumstance. And this is why, in some respects, I'm hoping that, except for maybe artificial intelligence, I'm not going to get replaced anytime soon, because there's a human component to it, to flesh out all the issues.
Okay. Scott, I want to thank you so much for joining me today. This is a complex area, and so again, as we said from the beginning, it's important for you to get professional advice, and I'm hoping from our conversation here, it sort of piqued to you, maybe that's something that I need to do. And again, we're going to be dealing with tax reform here shortly. We've been 20 years since the major change happened, and a lot of people still don't know. And imagine where we're going to be after that. So anyway, so to keep up with those changes, you need to get that advice. See you next time on Financial Insider Weekly.